Hello everyone, I'm Ingwan from AllQuant. Great to see you all again. Now, when we talk about investing into stocks, most of us are what we call long-only investors. So when we see someone go long, that actually means that they buy a stock, of course, with the view that it is going to appreciate in price. And then they will sell it later when the price goes up and hits their target. And from there, they make their profits. Okay, and this is your all too familiar buy low, sell high. All right, so in terms of process, what you do is you buy first and then you sell later. Okay, so today I'm going to talk about another way of how people can make money from the market besides going long, and that is your short selling. We can also say going short or just simply short. They all mean the same thing, and I'll be using all these terms interchangeably here. All right, so what is short selling? Not too hard to guess, right? Because the name already tells you what it is. It is the reverse of going long. In short selling, what you do is you sell first and then you buy back the stock later. Now, for those who are hearing this for the first time, you might be confused. I mean, why would anybody want to do that? Well, you will do that if you think the price of the stock is going to drop from here. Okay, then it will make perfect sense for you to sell the security now at what you think is a higher price, and then to buy back later when the price becomes lower. And in the process, you make money from the price drop. So to make things clearer, let's look at a simple example here. Okay, this is Tesla 2022. It is one stock that people either love or hate. Right? And it is also one of the best stocks to actually short last year. Now, by the way, I didn't short this stock. It is just a pure example. All right. So now let's just say that I got the perfect foresight, and at the start of 2022, I think Tesla is due for a drop. So I shorted 100 shares of Tesla at $352.26. Okay. And then I hit the jackpot, right? Because Tesla basically crashed, right, in 2022. Then I bought 100 shares back this year at a price of $108.10. So now for simplicity, if we exclude all the costs involved in putting on and maintaining this trade, that means I make a profit of $244.16 per share. Okay, this is the difference between the price I sold and the price I bought it back. So in total, over 100 shares, I make $24,416 from this trade itself. Simple? Got it? Now, to quickly summarize the difference between a long and a short trade. So when you go long, right, on a stock, you're basically bullish on it and expecting the price of the security to go up. So you buy the stock now and then you sell it later at a higher price. So this is buy low, sell high. Okay. And when you short a stock, you are bearish and you're expecting the price of that stock to go down. So you sell the stock first and then you buy back later at a lower price. So this is sell high, buy low. Now, shorting stocks that you think is going to fall, right, is one of the most common reasons why people want to short stocks. But there are other reasons as well. For example, some people may short stocks because they trade spreads. And a spread trade comprises both a long and a short trade at the same time. And others may short stock simply because they want to hedge the exposure to the market. But these are something that are more complicated if you're a beginner to the financial market. So I'll be keeping things simple here. So I will not be covering all these things. Now, some of you may already have noticed this interesting thing and are now like scratching your head, right? Because when you short sell, you actually don't hold the stock you wanted to sell. That is basically what short selling is about. If you already hold that stock, then it's not considered short selling. That's just basically like reducing or closing out your positions. So now, how can you sell something you don't hold, right, in the first place? If you do that, it is what we call naked short selling. And for retail investors, that is not allowed in the United States and many other markets. And even in countries where you're able to put on naked short sell trades, you are likely going to require to close it out within the same day itself. All right. So the accepted way, right, to short sell is what we call covered short selling. So that means you need to have the stocks first before you sell. And since you don't have the stocks, you will need to borrow them. And who can you borrow it from? From people who own the stock and are willing to loan them to you, right? Now, the good news is that you don't have to explicitly look for them and then go and back them to borrow or to lend you the stocks itself, right? Because your broker will take care of this entire process for you, and it all happens seamlessly in the back end. And why would anyone be so good as to lend their stocks to you? Because they can earn some extra pocket money. Okay, when you borrow stocks, your broker charges you a fee, which is called the stock lending fee, the stock loan fee, or the security lending fee, or whatever, right? And depending on the broker, your lender can have a cut on those fees. So for those of you who had a sizable amount of stock to sell, you may have already been approached by your broker inviting you to join in their stock lending program. And once you opt in, what happens is that your stocks become part of the pool of available shares for people who want to borrow and short. Now, when you put on a short trade, the payoff structure is the exact opposite of a long trade. Now, in a long trade, you buy the stock. So in this scenario, your profit potential is theoretically unlimited because the stock price can just keep going up and up, right? But your loss, on the other hand, is limited only to the capital that you put up. So if the case, in the event, right, that the stock crashed to zero, you just lose 100% of the capital. But when you're short, things turn the other way around. Your best profit scenario becomes the case where the stock collapses to zero. And in the event, you make 100%, right, which is the maximum that you can make. But your theoretical downside becomes unlimited, right, because you lose money when the stock price goes up and stock price can keep going up. Now, usually before such a drastic thing happens, you will get a margin call and the broker will close out your shorts for you. Okay, but in rare occasions, the stock price may spike up suddenly, right, well before you or the broker got any chance to react. And in case you don't think that can actually happen, then you can actually look up GameStop, right, and which was the target of a short squeeze back in 2021. It surged almost 140% from its previous day's closed when the market opens on the 26th of January 2021. So if you're really short GameStop, your game really stopped, all right? And if you don't think that is bad enough, there are also more jaw-dropping cases. Okay, this is a case by the REIT, which is recorded on the web. So there was a penny stock called Gateway Industries. It is a dormant public company back in 2011. So I do not know if this stock can be shorted or if there was even any interest or liquidity on it back then, right? But what happened is that it skyrocketed more than 20,000%, all right? From 2 cents to $3 immediately after it was being announced as a subject of an acquisition. So watch what you short very carefully. Now, the rules and regulations governing shorting can be different across different countries. And as for me, right, I'm focusing only on the US market. So in the United States, right, there's this rule called the uptick rule. And it comes into force if the stock you want to short is down more than 10% from the previous day's closed. Okay, and once it kicks in, right, that means that you can only short a stock at a price that is at least one tick above its latest traded price. So if a particular stock that you're looking to short is now trading at $10.10, that basically means that you can only short it at $10.11. Now, this rule is put in place with the intention of preventing excessive shorting pressures while allowing genuine buyers of those stocks more room, right, to exit their trades during sharp sell-offs. Now, some stocks are highly liquid and readily available for shorting. So your popular big cap stocks, such as Apple, is one example. But not all stocks can be readily shorted as and when you want to, right? Because it all depends on whether you can borrow the shares, okay, or the availability of those shares. Small illiquid stocks or those that are high in demand for shorting can pose a problem. So the famous GameStop, which was heavily shorted before it comes under attacks led by Reddit users, was one example. It was at one point so heavily shorted that you can't find any shares to borrow, right? And personally, I myself have encountered this issue a few times before. Okay, and as a quant who relies heavily on backtesting, that is very frustrating because not being able to short when a model calls for a short basically means that your strategy can be trashed. And related to this availability of shares for shorting is the stock borrowing fee, which I mentioned earlier. Now, this fee is not a fixed fee, all right? It can change based on market demand and supply. So if the shorting demand for that stock is high relative to the supply of the shares available for borrowing, then you can expect the borrowing fee to go higher, right? It is just simple economics, okay? Right, but do be wary, right? Because this fee can go incredibly high, right? Again, using GameStop as an illustration, its borrowing fee went as high as more than 50% per year in February 2021. So imagine what that is going to cost you to maintain this trade itself. Now, as a rough comparison, the average borrowing cost for shorting stocks actually range from between like 0.25% to 3%. Now, when you short, you borrow stocks to sell. Okay, when the lenders need their stocks back for whatever reasons they have, maybe they just sold off those stocks, then the brokers, right, have to take the stocks away from the borrowers and return them back to the senders. Okay, but this usually does not cause any problem because as long as there's still stocks out there that can be borrowed, the broker will just simply replace the stocks that are called away. However, there's always a slight possibility that there may not be enough stocks at a point in time. So in that case, then your shorts can get prematurely terminated. Throughout the stock market history, shorting have always had a bad reputation. So in any sharp market downturn, you can always count on the short sellers being singled out as the punching bag. All right. Now, as it is already not easy to make money shorting the market, given that the long-term path of the US stock market has always been up. And when what you do, right, is deemed to go against the interests of the majority, who are basically long-only investors, then more obstacles can potentially stand in the way. Okay, so don't be surprised, right, if regulators step in at times to impose further restrictions or shorting, or even outright banning it. And they have done that before, all right? So US regulators did ban shorting temporarily during the Great Financial Crisis in 2008. European countries, right, have also banned shorts during the COVID-19 pandemic in 2020. All right, that's all I have to share about shorting stocks here. I know there's quite a fair bit to absorb here, but I do hope that you learned something of value today. Now, if you like this video, do me a favor, hit on the like button. And if you have not subscribed to the channel yet, also hit on the subscribe button too. Okay, so a big thank you in advance for that. Finally, all the best to your investing, and let's all look forward to a better year this year. See you all later.